So here are my picks, for 2017 ETFs. I'm not looking to get the most return possible because the most return also equates with the most risk. What I'm looking for in 2017 is to take advantage of any market correction that comes about as a result of rising interest rates, or that comes about as a result of anything that happens in Europe that drives our market down, and picking up assets that over the long term with dividend reinvestment are going to produce for me the best possible returns. And I have like 5 or 6 different ETFs that I plan on picking up if that's the case, or adding more to the position that I already have. The first one being VT. VT is Vanguard's total world stock kind of ETF. It has 50% US stocks and something like 40% stocks from developed markets and emerging markets in Asia Pacific region, in Latin America, in Europe, in the Middle East and other parts of the world. It's very well diversified, and in case we have some kind of global drop that happens in a lot of markets, I might pick that up, just because I actually like the idea of having one ETF that has US based stocks plus global stocks. Another one I'm going to be looking at closely, especially right after interest rates go up, is VNQ, which is Vanguard's REIT ETF. And that's been my best producing asset over the last 10 years, because really the dividends that I have reinvested with the DRIP, which is a dividend reinvestment plan. I've picked up a lot more shares because of that dividend reinvestment plan, and on top, if you take that with the returns that are being produced on the value of one share of VNQ, I've come out about 12%, maybe 13%, somewhere around there, somewhere between 12 and 14% annually. That's how much it's increased, and that's because of the power of compounding interest. I like dividend stocks, and if the market drops down, I'm really going to go heavy into long-term dividend appreciation stocks. I like VYM and VIG from Vanguard. VIG is just the companies that have been around the longest that consistently pay out, a fair dividend. And VYM are the companies for the last 10 years that have been increasing their dividends. So their dividends have been going up and up and up every quarter for the last 10 years. You expect that going forward. There is turnover if some kind of company lowers the dividend and breaches that. But that has been probably, along with real estate, the VYM has been over the last 10 years for me, including the correction of 2008. That's been my best performer. These things consistently go up year after year after year after year, especially with reinvesting those dividends. You're just picking up more shares. The values are increasing. If the market goes down, it's a great time to cost average and to buy more. And that's what I plan on doing. I hope the market, takes a big dip in 2017 so I could just pick up a bunch of more of these ETFs for really cheap. On top of that, there's really 2 other ETFs that I'm looking at. Vanguard's Growth ETF, which is VUG, and Vanguard's VTV, which is Vanguard's Value. The difference between the two, they're both pretty much, large cap stocks. They're both stocks that, even though they have small caps in them, but there are a majority of these large cap stocks are in both. The VUG is growth sector stocks like the tech sector and things of that nature. Sectors that have an increasing influence on people's lives, while the value stock is mostly composed of companies that you utilize day to day. These phone carriers like Verizon, for instance, and you have your electric companies, your gas companies. These companies are not going anywhere. You've been paying the same people for the last 40, 50 years, and that's not going to change over the next 10 to 20 years. You're going to need power no matter what. You're going to need cell phone service and data service no matter what. So those kind of stocks are not as volatile, simply because, earnings don't decline for Verizon, maybe from new sales, but the earnings they're getting off their existing customers don't decline simply because the economy declines. When the economy tanks, people may use a little bit less power, but overall they're using the same power amount of electricity that they've been using over their lives. The difference is that the VUG has these companies like Apple that, if there is some kind of economic turmoil, really that's the first place people will cut, is a new expensive computer or a new iPhone, but they're not going to disconnect their service. So that's the difference between the VUG, which is the growth stocks, and the VTV, which is the value stocks. You ideally want to have both, just because the VTV, it might produce a little bit less returns really in the long run, as it has for me, but it's helped with the volatility, especially the swing in tech stocks. I mean, you don't want to never see swings that big and then basically have nothing else that's not doing as poorly. The key to investing long term is dividend reinvestment. Dividend reinvestment allows you to pick up more shares every quarter as you get paid out your dividend. Sometimes you get paid out dividends monthly if they're bonds or something like that. But I don't personally think that you really need bonds if you're looking at the long-term picture. I think for the long term, what we need to bet on is really two things. Number one, that the value of your dollar is going to go down in 10 to 20 years from now. It's going to be worth less. It's going to purchase less. The prices of goods and services are going to increase, and that's going to lead to an increase in the value of stocks of major U.S. corporations. And number two, what we're betting on is that having these ETFs, which gives a well-diversified portfolio within each ETF, having that is ultimately, in the long run, going to reduce our risk and be beneficial for our upside. So those are the two bets that I make personally in my investing career. I follow Warren Buffett and I follow Carl Icahn. I follow, people that have very long-term views on the economy. I'm trying to take out the guesswork. The easiest way to take out the guesswork is to simply do what I do and bet that there's going to be inflation. There's been inflation for 100 years, the value of the dollar since 1913, which is going on, right now, 104 years, 103 years. It's declined 97%. That's led prices to skyrocket across the board on everyday items. And if you believe that trend is going to continue, that, our central bank doesn't really have that many tricks up its sleeve to make it look like there's great economic growth other than devaluing the currency, printing more money, and devaluing the value in terms of dollars of goods and services in the economy. If that's what you're betting on, which is what I've been betting on, and it's worked magnificently for me, then you're safe with investing in these type of ETFs. So again, if you want a global stock ETF, go for VT. All the ETFs that I gave you, I choose Vanguard because they have the lowest fees and the best returns. Their management fees are the lowest. VT is good. VNQ for real estate. Real estate is going to be, in the future, a great producing asset. It always has been a great producing asset. It's limited in supply, and the value keeps increasing. Land is ever more valuable the further higher and higher we build, especially in bigger cities. You want to also get your dividend growth stocks, because the dividend growth stocks will grow the quickest in terms of dividend reinvestment, along with real estate. Real estate pays phenomenal dividends, and so does obviously your dividend stocks. Those are the best. And you want to think long term. You don't want to think what the price is doing today or in a month from now or next year. You want to think about what's going to happen in 5, 10, 15, 20 years down the line, and how can I accumulate holdings by not only betting on the price, but also increasing the amount of shares that you own. And you can do that simply by getting into high dividend yielding stocks and making sure you're on a dividend reinvestment plan with your broker. I recommend TD or Schwab. And you also want growth stocks, and you want the, large cap value stocks. You want VUG and you want VTV. And those are my picks for 2017. And for 2017 into 2027, those are the ones that I'm going to hold. I don't like betting on winners and losers. Neither should you. If you're looking at retirement, long-term investments, buying an additional vacation home 10 years from now, you don't want to risk it on a winner and loser that a drop in could take time to recover greatly from. Take my word for it. I'm speaking from experience. These Vanguard funds are the best way to really invest into your future and minimize your risk. Of course, there is risk in the markets, there are risks in the short term, but in the long term, remember, we're betting that prices will go up in the economy in general, and that's the prices of housing, the prices of food, the prices of healthcare, the prices of everything that you can think of, and in turn that leads to higher prices in the stock market, higher prices to your ETFs, and with a dividend reinvestment plan, you get higher returns than average. It's in Asia Pacific region, in Latin America, in Europe, in the Middle East, and other parts of the world. It's very well diversified, and in case we have some kind of global, drop in 2017, is to take advantage of any market correction that comes about as a result of rising interest rates, or that comes about as a result of anything that happens in Europe that drives our market down, and picking up, assets that over. First one being VT. VT is Vanguard's total world stock kind of ETF. It has 50% US stocks and something like 40% stocks from developed markets and emerging markets. The long term with dividend reinvestment are going to produce for me the best possible returns. And I have like 5 or 6 different ETFs that I plan on picking up if that's the case, or adding more to the position that I already have. So here are my picks for 2017 ETFs. I'm not looking to get the most return possible, because the most return also equates with the most risk. What I'm looking for